What's up, YouTube? It's Tastyworks here with Taste Tracker, and I wanted to go over a real example of getting assigned. This is not unexpected. I knew it was going to happen, but I'll just walk you through the steps of the whole process and why it's not scary. So today is Saturday. I knew I was going to get assigned on these puts that I wrote. The expiration was yesterday. I sold the 10 strike put on AQB. So I just got this email at 11:08 this morning. So you can see here that it does take some time for the whole process to work out. So the options stopped trading at 4 o'clock yesterday, but then after that, the stock continues to trade. So there is a potential that you will or won't get assigned depending on the strike that you chose and where the stock's trading at, etc. So if it's right on the bubble and the stock was trading at 10:05 at 4 o'clock, but then after hours it dips down to 9, I'm going to get assigned and I can't really do anything about it. I should have closed that option out before the close of business on Friday. So that's why we always say close out your options if you are not willing to get assigned, and especially if you have spreads, because there are definitely times where the stock can close in between your strikes, and then you'll hear horror stories of people getting assigned on one of their legs, but they don't have time to exercise the other leg, and the broker didn't do it automatically for them, etc. So it's just much safer to go ahead and close out all your positions the day of the expiration. So the last thing I wanted to point out here is Tastyworks sent me this nice link here, which I'll go over in a second, and I'll also put that in the description. And this is kind of what sets other brokers apart from good ones from bad ones. So if I come to that link here, I have a video, and then it walks me through a couple scenarios. This video is specifically with spreads, but the same logic applies to naked puts as well here. But yeah, if you get a cheaper broker that doesn't have all their documentation in place, and you cannot reach them, this can be very scary. With somebody like Tastyworks or any other good broker, you can get a hold of support, first of all, which is great, and then they have this stuff, so a lot of times you don't even need to contact them to begin with. So let's go over the position and what happened. On the 1st and 4th, I opened up a short put, which means I sold a put, which means I'll get assigned if the stock closes below $10, and we'll check that out in a second. But for the first one, I collected 114. For the second, I collected 126. So let's go ahead and do the math on that real quick. If I add those two together and divide by 2, my average credit for one contract is $1.20. Or if we multiply that by the 100 shares, then that would be $120 I collected per contract. I sold the 10 strike puts, which means if I were to get assigned, my cost basis for the shares would be $8.80. So I took the strike that I sold minus the credit received. That equals my cost per share. And I'll get to this last line here in a second. So let's go ahead and go look at the chart and see what I was thinking and where it is now. So on 2-1, that's in this area here, I'm thinking that we're going to have support here at the 20-day, and so that it will bounce up. And it did do that for a second, but then it immediately plunged right through. So that's kind of what always happens to me when I do wheel strategies. They always go against me. I can't be the only one, so maybe I'm picking the wrong tickers. Let me know your experience in the comments below, but almost always when I'm doing this kind of style of trade, it always goes against me. So anyway, so I sold my strike here below the 20 days. So the thought process here is that it would bounce up, it would expire worthless, and I would collect on my $120 per contract and never have to take ownership of the shares. Well, that didn't work. It broke through the 20-day, bounced off the 50-day for a second, and then broke through the 50-day. So at this point, it's very likely that it comes the whole way down to the 100-day. It doesn't have to, of course, but that would be at $7. And right now it's holding up at around $8, $8.30, somewhere in there. On the plus side, the MACD and the RSI is curling up. They're losing steam at this point. So we could see a bounce here very shortly. And then we've got earnings. So if that were to go well, very easily could come back to $10. Of course, if that goes poorly, who knows? It could come down here to $6 or $5. We don't know, obviously. Um, yeah. So the last thing I'll show here is the covered call. So um, now that I have the shares, actually, let me show you this. I actually only have $2,000 in this account. Because I took ownership of the shares and all of these funds haven't settled out, it's showing that I have about $4,000 and buying power is 2,048. What it actually will show sometime Monday, probably around lunch, this will drop down to $48.59 buying power. But because the shares that I got assigned have value, but um, but they haven't taken the funds out yet, it looks like I have a lot more money in here than I actually do. But we can come over here and see I do have the 200 shares of AQB. So my contracts are already gone for that expiration, and I'm just left with the shares. So if I go to the trade screen and then I look at the next expirations, uh, I'm going to choose the next monthly and look at the 10th strike again. Because my cost basis is $8.80, I definitely don't want to sell the 7.5 one, the $7.50 one, because that's below my cost basis. If I were to get assigned, even though I collected $75 on this, that would bring me down to $8.05. And so I'd be almost locking in a loss of $50. So I definitely don't want to do that. I could do the $10, and if it does stay at this $2.30 premium, that does look actually pretty attractive. If I did that, I would collect $2.30 plus the 120 I had originally for a total of $3.50 um, per contract. Then you minus that from the share price that I paid $10, and so that would bring my cost basis down to $6.50. So again, if we go back over to chart, $6.50 brings us down here below the 100 days. So that's actually a good place to be. It lowers my cost basis even more. And then if the stock were to shoot up to $12 or something like that, and I'm forced to sell my shares at $10, I'm actually really okay with that because that's locking in $3.50 per share profit if it were to come up above. Of course, if it shot up to $20, I would feel a little stupid. But that is the name of the game. Okay, so those are my choices. I can immediately close out the shares, which is something you would want to do if you were did not have enough margin in your account. You would get margin called. So the next business day, you would sell your shares, and then everything on your account, once the dust settles, you would not need to deposit more to satisfy the margin call. Selling of the shares would do that for you. Since I do have enough in my account to cover it, I can hold the shares or I can sell the covered call that or just sell because I don't want to hold that position anymore. So whether or not I do the covered call depends on this premium. If it goes down to 50 cents on Monday, then I'm not interested in selling the covered call because I'm limiting my upside with very little compensation. If it stays at 230, like I said, the math here looks attractive to me to reduce my cost basis and to force the market to, if it does go up, take my shares away. I don't have to even sell them, and I get 350 per contract, so that's $700, which would be pretty nice for this share, for this size position. All right, so I think that's all I wanted to cover. Let me know if I missed anything or if you have any questions, and I'll be happy to answer them. Otherwise, I'll see you next time.